Hello everyone, welcome to the Mining Match. Let's begin. So today is a special event. We have two speakers. One is the Vice President of M.Plan, joining us from Norwich, the UK. He is Derek DeBitt, and Sebastian Wallet, joining us from Germany. He is representing M.Plan. So we're going to talk about specialty metals and minerals, because those are the future of creating renewable energy and to help climate change. And especially the big market right now is the batteries. So we need essential minerals and minerals like lithium to make this possible so we can help our planet.
Excellent. Hi, everybody, and thank you very much for attending this presentation today. It's about the comparative or the comparable transaction value curve. Now, this curve is not something new. It has been used in other commodities as well. It has been used in quite a number of commodities in the past. But what is new is the application of the comparable transaction curve to specialty minerals and metals. And we are going to explain the curve using lithium, but we can also develop the curve for other specialty minerals, for instance, rare earths or vanadium or graphite. The agenda is on the left-hand side, but I'm not going to go through the agenda in detail. So I'm just going to skip through that. And this is the normal disclaimer. We will have the presentation available to after today, so people can then in detail read through the disclaimer. I'm not going to read through the disclaimer in line by line. I'm going to go straight into a little bit of explaining and giving a brief introduction about M.Plan and who is M.Plan and what do M.Plan, what services do we provide. So M.Plan combines the expertise of its shareholding companies. And there's two shareholding companies. There is Micon International. It's been in existence for over 30 years. And then there is Döpfner M.Plan that's been in existence since 1985. The Döpfner Group, they've been in existence significantly longer than that. Micon provide technical services, geology, mining, metallurgy, environmental, and M.Plan, they provide analytical service, test work facilities, but also consulting services. M.Plan, through Micon and M.Plan, specializes in specialty commodities. So that's the only commodities that we provide services. And to give you a little bit of an introduction on specialties, those are the battery grade commodities, you know, the graphites, the lithiums, the nickels, cobalt, vanadium, also the alternative power generation commodities and your critical minerals, rare earths, scandium, niobium, tungsten, and then this very high value industrial and high purity commodities. And M.Plan can provide you with a full services from geological drilling, metallurgical test work, and all the way through to market assessments. So we offer integrated services, as I've indicated. And what is very important in specialties is this last item on the list, this market intelligence, because within specialties, the market require a little bit more of an assessment, because for the majority, specialties are not freely traded. So you can't go to the London Metal Exchange and get commodity prices for high purity lanthanum, for instance. So you need to do a lot more research to get to your market intelligence and to understand some of these very high purities. We are the expert, and our focus is on specialties. As I've said, we've been in existence for 30 years, and we provide services to mining companies, financial institutions, trading houses, chemical and automotive industries, just to name a few. And the commodities, as I've already discussed, these are lithium, cobalt, nickel, graphite, scandium and rare earths, vanadium, high purity alumina, and quartz. And we don't get distracted by the conventional commodities like the gold, the PGMs, the coal, the iron ore, and the manganese. We only focus on battery grade commodities, alternative power, and the high grades. So what are specialty commodities and what are their characteristics that differentiate them? And item number one is that these are highly refined commodities. Now, when you talk about certain of these rare earths, they can be 99.99% pure. That will be their requirement, to be that pure. But it's also sometimes the impurities that is very important. So one of the key differentiations is this highly refined characteristics that you get within specialty commodities. We do exclude the base and the precious metals. Another characteristic is that they're fairly rare, or in geographically limited areas that you find them. They require a very novel process and refining route. And compared to your bulk commodities and your precious metals, they are fairly low in annual production. They are used in very niche and very high technology applications. And what is a benefit is that because they've got this unique characteristics, they limit substitution. So if we discuss a little bit more the future growth of specialties, and especially at the moment when we look at this global electric vehicle drive, then Deloitte predicted last year that your electric vehicle market, that will show a compounded annual growth of 29% over the next 10 years, with electric vehicle sales increasing from 2.5 million last year to over 11.2 million in 2025. If you look at heavy-duty electric vehicles, they predicted to growth by about 9% compounded annual between 2020 and 2025. And that is due to the adaptation of electric trucks. Then you've got the electric vehicle market growth. That's all due to this very strict automotive emissions limits. You've got the EU that set 2050 zero greenhouse gas emissions targets. And that's driving quite a lot of demand for specialty commodities. And then Europe is looking to have a total ban of ICEs, that's your internal combustion engines, by 2040. So in 2019, more than 90% already of your global car markets by sales had electric vehicle incentives. If you look at Australia, you'll see that just between 2019 and 2020, which is really the economic challenges due to COVID, between 2019 and 2020, there was an increase from 7.5 to 14, which is really a doubling thousand vehicles that registered as electric vehicles. In the center of the presentation, you'll see that more than 2.2 million electric vehicles were sold globally in 2019. And the average plug-in market share, that improved by 2.5. That's overall. And of interest is to see, how countries plan to switch their vehicles to 100% electric, starting off, 2025 with Norway. But then there's going to be a real big push in 2030 when the enormous market of China and India plan to switch. And then 2032, smaller market, 2040, England and France and so forth. There's also this battery boom, and if you look at some of the sayings from benchmark minerals, they say by 2029 demand for nickel, that will double. Cobalt, that will be 3 times. Flake, graphite, manganese, now that's manganese for batteries, 4 times, and then lithium 6 times. So they reckon that the tectonic plates of this industry have basically shifted. There's just some graphs there to show, 2018 versus 2030. There's quite a big demand. Again, nickel within batteries, and that's leading it. And then there's also this projected demand from Bloomberg from 2020 to 2030. So we know that there's going to be a big demand. And what is currently the focus is to find the projects to develop to be able to meet this big demand. One of the very big differentiating factors within developing a specialty commodity project is how it really differs compared to your conventional commodities in declaring a resource. Now, generally, if you have a conventional commodity and it's got a basic good grade or a marginal grade, you do know that there should be potential for eventual economic extraction, because the metallurgy for these conventional commodities have been defined fairly well over the last, in some instances, more than 100 years. But when you talk about specialty commodities, that's not necessarily the case. That's not necessarily when you've got a unique ore body within specialty commodities that you've got potential for eventual economic extraction at the outset. That means you've got to start with your metallurgical test work quite early. So your early test work to evaluate that potential market application and the product specification is very good. And you need to determine that to ensure that you can meet the market application and the product specification. It helps us to define your exploration strategy and your target. So further test work will then identify possible process flow sheets and costs and the economic potential. And then you can complete your mineral resources and eventually move on to reserves after your PEA. So it's fairly important at your very early stage to start with your test work to evaluate and actually prove that your ore body can produce a product that there is a market application for and that you can meet some of these very high purities. So the uniqueness of specialty commodities, they require a distinctive development and due diligence approach. And obviously, M.Plan, who focuses on specialities, we've got a tailored, distinctive approach that we follow to assist companies to develop. A little bit more onto mineral asset valuation. For those that's not that familiar with mineral asset valuation, a valuation of a mineral asset is to determine the monetary value for which the property will transact on a particular day, and to have a fair value, you will say at an arm's length transaction. So it's all about determining independently from an arm's length, what is the monetary value of that property? Why would you want to get your mineral asset valued? Well, you might need the value to purchase a property. You may want to get it valued because you are selling your property. You might want to get it valued for insurance reasons or tax reasons or investment and financing reasons. These are just 5 of the major reasons why you would like to get your property valued. There's obviously a lot more other minor reasons of getting your property valued. Of importance is that basically there's three major international mineral asset valuation codes. There's the Wellman Code, which is the Australasian code. There's the SimVal code, which is the Canadian code. And then there's the SAMVal code, which is the Southern Africa code. But for the majority, these codes are fairly similar. And one of the reasons why they're fairly similar is that the standard for mineral property valuation, that's guided by the M.Plan template. And these codes does fit into the M.Plan template. If you are a new country and you wish to develop your own and your unique valuation code for whatever reason, then it would be very good to start off with the M.Plan template and base your valuation code on that template. If we look at explaining a little bit the valuation approaches for the different type of properties, there are basically three approaches. And I'm going to explain that using residential property because we all understand residential property. Most of us, if not all, has got a house. Most of us has had the opportunity to buy a house or sell a house. So it's easier if I use a residential property to explain it. So the first approach is your cost approach. And in terms of residential property, you will say, what is the cost of the land? What is the cost of the bricks, the mortar, the tiles, the wood, the tiles for the roof, the electrical component, and you will all add all those different components together. And at the end of the day, a QS will then give you, using the cost approach, what is the value of your property. And that's very similar to a mineral asset valuation. In the case of a mineral asset valuation, you will look at your assets value using your meaningful past exploration expenditure, plus what warranted future cost will be required to do the remaining of your exploration. So that's normally when you are in early stage project development. That's discovery and maybe going up to a preliminary economic assessment. That's your cost approach. Then the next one is your market approach. That is when you compare your house to that of your neighbor's house. And you say, my neighbor has just sold his house and he got for his house $500,000. So I should get $500,000 because from a substitution point of view, I'm substituting and I'm saying that is the value of my property. Now, the market approach is thus also the approach that is being used to develop this comparable transaction curve because it's using previous transactions on mineral assets. And that is exactly what the market approach does. It looks at other mineral assets that was bought and sold in the public domain, public documentation, databases, and so forth, and it determines a price for an asset using previous transactions. Now, the final one is the one that we probably knows best, and that's your income approach or your discount cash flow approach, where you develop a model. Now, basically, you're only allowed per the valuation code to use the income approach after you've done a pre-feasibility study, when you've converted resources into reserves and you've developed a mine schedule. There's normally two approaches required. And as you can see, early stages, that's your cost approach and your market approach. But then later on, it will be your income approach and your market approach. So what is the market approach, the assumptions in the market approach? Well, you say basically that similar assets or similar houses will have similar comparable transactions under the same circumstances, under the same conditions, in the same time. If your neighbor has got exactly the same house as yours, then At the same time, basically, you should get the same value as your neighbor. And that's the assumption. It's saying if the circumstances is the same, if the conditions are the same, and at the same time, these transactions should have similar values. Then what is very important is to actually find a market proxy. That's your basis, that's your simile to establish a comparable value. Now you would know that your neighbor's house is not going to be the same as yours. So you're trying to find a neighbor's property that is very similar to yours, because the closer they are, the more comparable these transactions would be. And we do exactly the same within the mineral asset valuations, and that is establish a proxy. So what is the advantage of the market approach? It's very straightforward. It's a straightforward calculation. The nice thing is that it's based on actual market data, and it's applicable to all the development stages. The limitation is that it can be fairly difficult to find comparable mineral assets. And for that, you need a good, broad database of information, as we've used to find these comparable transactions. The table graph, the table or the presentation at the bottom, that just shows you the three approaches. You can see there that the market approach, which is the one that we discuss a bit more today, you can use that within exploration properties, mineral resource properties, development properties, and production properties, and that's according to the SIMVAL code. Whereas most people tend to use the income approach, which is really not suitable for exploration properties. For the majority, it's not suitable for only mineral resource properties, definitely for development properties and for production properties. Good, so I'm now going to hand over to my colleague who will take you through the rest of the presentation.
Well, thank you very much, Derek, for the introductions to specialties and specialty minerals and valuation. And now I'm going to focus on what the curve is, what type of data it uses, how it is constructed, and what it can provide. In this case, it is exemplified by a lithium curve, but it also works for other commodities, as Derek has already explained. The reason we wanted to create this curve was because we wanted to provide a simplified and straightforward approach to value specialty mineral assets. And it is based on the market approach. And within this approach, it utilizes the comparable transaction method and the market capitalization method. The first one is fairly important since it is based on actual real market data. And the market capitalization uses the market capitalization of companies, and that, for example, only possess one asset of interest, one asset of the metal of interest. And it is based on the efficient market hypothesis. One of the main features of the curve is the illustrative way to compare different assets. And as a comparable unit, we used US dollars per ton of contained metal. This methodology has recently been independently endorsed by one of the 4 major international accounting firms. However, this is not a novel approach, but it has been around in academia for years, as shown in the image on the right, where one case of a valuation curve for PGE mineral assets was developed. And it already shows that there's a trend where with increasing resource uncertainty, there's an increase in value, which is to be expected. But it has not just been used in academia, it was also applied in industry by companies such as Deloitte, E&Y, Minexcon, or Mineral Valuation Group. But what makes our approach, or what differentiates our approach from theirs, is that we apply it to specialty commodities exclusively, which M.Plan is capable of doing due to our extensive experience in this field. So what type of data do we use in constructing the curve. Our reliable primary source for data is the S&P Global Market Intelligence database. And S&P is a leading provider of financial and industry data, and it tracks publicly announced mergers and acquisitions, public placements, and more. An additional data source for us, or a secondary source, is our publicly available reports or stock exchange filings. And we use that to either add information or to cross-check data where we find necessary. In total, or in general, we need three main types of data. First, we need information about the resource and reserves. And within that category, we need the resource and reserve size and also the grade, which are both important to calculate the contained metal. And also another important information are potential byproducts, since byproducts may significantly contribute to value for mineral assets. And the way we account for this is by converting those to equivalents of the metal of interest. Actual transactions, as I said, are really important for our approach. And because these are actually transactions that have occurred in the market. And we apply corrections based either on commodity index or commodity prices. And the reason for that is shown on the right. And for the case of lithium carbonate. And you can see how the lithium commodity price changed with time. And of course, it has a tremendous effect on transactions, whether the transaction happened during a boom period, for example, up here, or during a bust time, for example, down here. And in order to accommodate for those changes, we apply corrections, which can also be based on a commodity index, which represents the industry of the metal of interest as a whole, and is thus more versatile and more comprehensive. And the third main type of data that we use is the market capitalization, which can be used for companies that possess only one asset. And for the same reason as I've explained for the transaction costs, like we don't use just a spot value for example, at the time of valuation, but rather a 3-month average to account for variations. So when we build the curve, like first, if you look at the x-axis, which shows the resource confidence, and it is basically a resource and reserve classification, and we use a weighted average calculation in order to assign the certain location. And we use that to account for the variable proportions of different confidence classes. For the calculation, it is important only to use the attributable resource and reserve base, which means if a company owns 50% of a mineral asset, only 50% of that resource and reserve base is used for the calculations. Then next, the y-axis, which shows the value. In this case, as US dollars per ton of contained lithium oxide. And we can generate two values for a mineral asset that has resources and reserves, for example, like one for the resources and one for the reserves. However, it does only we only use one of them because only one of them contributes most to the value. And so we need to look at the mineral assets individually in order to find out which of the two is more appropriate in that certain situation. Then if we then fill the data in, it is important only to use data of comparable types of assets. For example, for lithium, you can have pegmatite-hosted lithium deposits or brine deposits or clay-hosted lithium deposits. And of course, the type of deposit has tremendous implications on the processing in the geology and thus the economics of that project. So it is important to only focus on one type in order to make it as comparable as possible. It is also very important to use only code compliant resources and reserves, since we can then be sure that these resources and reserves have been developed according to certain standards. And we apply commodity index adjustments, as I mentioned previously, And for the transactions, we try to use as recent transactions as possible. For example, only ones that occurred within the last 5 years. And the way that the valuation would then generally work is we look we try to place the deposit of interest along the x-axis, for example, up here. Then we go up there. So we know roughly that the value could be in this range, since the curve provides indicative value ranges and gives us an idea about the magnitude of comparable values. And then it is important to find the proxy or the simile, as Derek explained. So we need to look at the data points in this vicinity and see which ones of those is actually most comparable to our mineral asset. And then we value that specific asset relative to the most comparable one, thus the proxy, taking into account all the special features that the mineral asset possesses. So the curve, the curve does not only provide value indication, but also other information. And the example for the lithium curve is shown on the right. And it shows more or less the same trend as in the academic example before, where with increasing resource certainty or developments with increasing higher development stage, the value increases as well. And in this case, for the lithium curve, which was developed for pegmatite-hosted lithium assets, the value seems to be mostly determined by factors such as policy, infrastructure, or geopolitical risk. But all other factors also contribute to the value, such as mine type, whether it's open pit or underground mine, or if there's also production of value-added products. For example, if you have processing facility at the site of the mine, the value will be higher as compared to if you do not have a processing plant. And in general, this curve can be used to establish relative price ranges for mineral assets, for example, for acquisitions and disposals. It can be used for impairment testing, comparison against other valuation methods, or to determine insurance value. In general, it is important, though, that to have experienced personnel conducting the valuations, since it is important to see the whole picture, and especially for specialty minerals, it is important to look at not just the grade, but also, more importantly, the exact mineralogy, the setting, and texture, for example. So to summarize, this newly developed valuation curve complements the existing service portfolio quite nicely, and it's supported by M.Plan's vast experience and expertise in specialties. And this allows us to address our customer needs in a more comprehensive way, all the way along the mine life cycle. And that's it from my side. Thank you for attending, and I hope you found the talk interesting. I will now give the floor back to Ellen, and if you have any questions, just let us know now. Thank you.